Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
We begin this hour with S&P 500 set for a weekly gain. Savita Subramanian of Bank of America writing, sentiment is far from euphoric. The consensus Wall Street broker is recommending an average allocation of just 56% to U.S. stocks. This is not euphoria. Savita joins us now. Thank you so much. Good morning. Thanks for joining us. So if it's not euphoria, what are we in right now? What is this world?
Yeah, this world feels weird, but I think we're in that sort of wall of worry stage where there are certain themes that are getting a lot of credence and credibility, like AI. Other themes are kind of falling out of bed, like GLP-1. And then you've got this potential broadening of the market that we've all been waiting for with bated breath that I think is at a moment where it's actually in the works. So if you read the transcripts, and I love Lori's quote, but I think that when you read the transcripts, companies are worried, but they're also talking about the fact that they've delayed a lot of projects. They haven't canceled them, they've delayed them. That means there's a lot of pent-up activity, business activity in the pipes that is likely to be unfurled over the next couple of quarters. And I think what really stymied that pickup in broadening and kind of other companies actually moving from their very low multiples and low levels is the idea that we're past a lot of the tariff uncertainty. I mean, granted, there are curveballs that are thrown at us every day, but we do know what's going on with Europe. We've got a better handle on how companies can actually plan and do business. We're also starting to see, I think, the beginnings of this M&A cycle, even cross-border M&A. So I think those are other animal spirits that could unleash a broader pickup in economic activity. And then when we look at things like, companies reporting, I think what's really noteworthy is that at this point, about 80% of companies have beat on revenue. That's new. We haven't seen this revenue surprise in a while. So what that means is that analysts marked down expectations very low for sales and demand, and they're beating those lowered expectations. So I think this all bodes well for a broader market. I would stick with large cap value stocks, companies that are, really in the penalty box, but could actually start to work in an environment where, we do see earnings broaden and a bigger pickup.
What happens if you add in rate cuts to all of that? Is that just jet fuel for the broadening out and even maybe for some of the smaller companies?
I think it's jet fuel for small caps. I don't know if large caps need a rate cut. I mean, the thing that I like about the S&P 500 is it's kind of immune to the Fed because a lot of these stocks really move more on long rates rather than short rates. So I think that, the refinancing risk is really firmly in the Russell 2000 rather than the S&P 500. But I do think that a Fed cutting rates from these levels would be sort of a driver for more positive sentiment on stocks, a shift out of cash into stocks. If inflation remains high, I think there's one pocket that the bulk of individual investors have to go to. So think about individual investors. They're mostly retirees. They're sitting in big tech stocks and cash. If cash yields are coming down, but inflation is still relatively high, what are you going to do for real yield? This is where I think that dividends, cash return, et cetera, come in. What worries me a little bit about the big ballast of the S&P 500, the AI spenders, is that these guys are becoming more capital intensive. And that might not be great for multiples, for cash return, et cetera. In fact, we wrote a note this morning highlighting that the Magnificent Six, if you take out Tesla, is growing much more capital intensive and less R&D focused. And I think that's something to watch because we're sort of in the middle innings, I think, of an AI spend cycle. And if that continues, the asset lightness of these mega cap tech stocks is potentially compromised.
Your note you have, we are moving from, quote, everyone's spending on tech to tech spending on everything. Danny,
Exactly.
this has been a story of the entire quarter.
Yeah, it has been the story, and it's been a lot of the reason why it's hard to be bearish. But I do think this idea of the business model changing is so interesting, Savita, because part of the thing that people bought tech for was because they were capital light and you could get those really high valuations.
And great growth.
And great growth.
And free cash flow.
So is there now a ceiling, or will there start to be a ceiling on multiples, on valuations, if it's a different business model and all of a sudden they're capital intensive?
Well, I think you need to see the revenue beats for these companies, because if you don't see top line really accelerate along with CapEx, you're cutting into that earnings, you're cutting into that free cash flow. We've already seen the total shareholder return for the Magnificent Six drop since 2015. We've seen CapEx to sales pick up. We've seen R&D to sales decline. It's all happening. The question is, when will it get priced in? Because these stocks are trading near their all-time highs in terms of multiples. I think what we start to see is a trade-off where old economy stocks are getting all these new tools to get more efficient, asset light, labor light, et cetera, whereas tech companies are starting to get more asset intensive. It's a very sort of slow burn shift or handing off of multiple expansion to multiple contraction, but I think it's something to keep an eye on.
When it comes to policy, we have the one big beautiful bill.
Yes.
There is a little bit more of an understanding what's going on with tariffs.
Yeah.
What are you waiting for out of Washington? What's the next shoe to drop?
You know, I think right now there are not a lot of catalysts, and maybe, the Fed obviously, but I think that we're in an environment where our near-term outlook on equities isn't great. I mean, we think a lot of the good news is priced into the market. If you look at reactions to beats, they were pretty good, but reactions to misses were terrible. In fact, the worst downdraft to earnings misses and sales misses in the history of our data since Reg FD back in 2001. So this means the good news is probably more than priced in the near term. I do think if we see this broadening of earnings growth and we see a pickup in some of the economic indicators, maybe the Fed cut is compromised or a continued cutting cycle is compromised, but I think that's the driver for better earnings.
And you still think we're going to be at 6,300 year end?
So 6,300 is our year-end forecast. I think it's tricky because we've also got the midterm elections coming up. So our 12-month forecast, which is probably more important or relevant, is really for more like 5% gains from here. I think what's interesting, though, is that the years where you've seen the biggest earnings recoveries haven't necessarily seen the strongest market returns. So that's kind of what we're operating on, is the idea that earnings are coming back, we're exiting a manufacturing recession, but market returns aren't necessarily going to be blockbuster.
Savita, thank you so much for your time this morning.
Thank you.
That was fantastic. Savita Subramanian of Bank of America. We're joined by former Chief International Trade Counsel for the Senate Finance Committee, Bruce Hirsh, and he writes, our trading partners have had to adjust to the idea that these deals need to include offers to purchase specific U.S. goods or commit to invest in the United States. The bigger the number, the better. Bruce, thank you so much for joining us. This is exactly what Danny and Oliver were just getting at. The issue I have with this premise for Switzerland is that they are top 5 foreign direct investor already into the United States.
Well, they certainly are, and we have a close trading relationship with them, but we also have a trade deficit with them, and a large part of that deficit is on pharmaceuticals. And pharmaceuticals is one of the areas of great concern to President Trump. He wants to onshore that manufacturing. So he's going to look at that deal perhaps a little bit differently than he looks at some of the others. Also, he's really been counting on our trading partners to reduce their tariffs to close to zero, and that's difficult politically for a country like Switzerland to do on agricultural products.
So what do you think Switzerland can offer at this point, given the fact that Oliver just outlined how difficult these negotiations have become?
Well, I mean, there's the possibility that they'll make some very tough decisions on agricultural tariffs. Beyond that, if there have any other investments in the bank to put on the table here, that probably is going to be critical. I mean, I suspect that President Trump is looking for some sort of investments in domestic manufacturing here of pharmaceuticals, because that, again, is what he cares about. But it's hard to say, and they really are between a rock and a hard place.
Bruce, Anne-Marie's done really great reporting on this, that it did look like the Swiss and the U.S. had a deal before all of this unraveled. It's a less traditional type of negotiation that you need to satisfy the president himself rather than a coalition of stakeholders or the Senate itself. You've been in the room under more traditional trade frameworks. How does it change the negotiation when you're really trying to favor a party of one instead of more stakeholders?
Well, it's going to lead to a bit of confusion on both sides of the table because, I mean, as you mentioned, at one point, the question was, how do you satisfy Congress? They're the ones who have to approve the deal at the end of the day. The groundwork will have been done with Congress, with stakeholders to develop a U.S. position. Consultations will continue. You have a good sense of what you need to do. Now you're trying to satisfy a party of one. And because President Trump has a number of objectives and they can shift, whether it's revenue or industrial policy or leverage for trade or non-trade objectives, you just don't know. So both sides are at the table and they're trying to figure out what will satisfy President Trump, and they're not really quite sure.
Well, to that point, we're in this environment where it has been figure out the top line of the deal first and then the details later. Bruce, to what degree does that actually give the U.S. more leverage as things progress? The fact that we don't have these details, and it is something that Washington can push back on because you don't have the details in the fine print yet.
Well, it certainly gives the opportunity for leverage. It also gives the opportunity to disrupt the deals that you've just cut. We've already seen in some of the deals, both with the EU and Japan, they're concerned about when certain parts of the deal with regard to Section 232 national security sectoral tariffs, when they're going to be implemented. They were expecting them to be implemented right away. And that hasn't happened. So yes, it gives leverage, but the question is at what cost, and will it blow up the deal? So it's a great challenge. It also sort of undermines a lot of what these countries are looking for and what the markets are looking for, which is stability. Because to the extent that there are other things like that, there are these opportunities to disrupt the deals by continuing to push after the top line has been agreed to. That can undermine that sense of stability that everybody is seeking.
Modi is looking for stability right now. Bruce, what's going on with India and that trade negotiation?
Well, again, this really highlights the fact that the deals are made at the top. And, we had a situation in which the negotiators, right up to the cabinet level, thought they had a deal with India. It was presented to President Trump, and he looked at it eventually and decided not enough. Again, a lot of countries are going to zero. India wasn't willing to go to zero on their agricultural goods. And so he just said no. And this is going to create a real challenge for a number of reasons. India's going to have to make some tough choices potentially. They may have to themselves cut a check of some sort. But politically, it's very difficult for Prime Minister Modi because he presents himself as a strong leader, and having to appear to cave to pressure is really going to be very difficult for him, either on these tariffs or on the relationship with Russia. So it's going to be a challenge on that one.
And he's even go out with the rhetoric saying this is going to be challenging, but I'm going to have to do it. He doesn't want to cave at this moment. We're going to be watching those trade negotiations very carefully. Former Chief International Trade Counsel for the Senate Finance Committee, Bruce Hirsh, thank you so much for joining us. Vinh of Keybanc has a sector weight rating on Intel's shares. John joins us now. John, Mandeepa's really outlining here that it's not just the President of the United States. He might be the final nail in the coffin, but actually there is the board that's pushing back on the CEO's strategy right now when it comes to Intel. Do you think he can stay in the top position?
I think he can, right? I think if you kind of take a step back, there's only a handful of executives out there that are capable of leading Intel. And clearly, during the search, he was their top pick, right? He was on the board of Intel's, deeply familiar with the challenges that they had. He's had a lot of success historically. He's been successfully run Cadence. So I think I think there's a lot of noise going on right now, but taking a step back, he's the right person to kind of run Intel at this point.
He's the right person, John, but what happens if it's a White House that is unsatisfied if he stays on as CEO? Just how painful could they make things for Intel?
Yeah, I think he's got to learn to to kind of manage up, if you will, to the White House. Obviously, this is a uncharted territory for public company CEOs if you are singled out by the President of the United States. But yes, this would be extremely difficult if he doesn't figure out how to kind of manage up to the White House. A big beneficiary Intel is of the CHIPS Act, right? They're going to get a significant amount of funding from the U.S. government to support their manufacturing initiatives. And if he's not willing to play nice and manage up, a lot of that funding could be at risk.
Well, he wrote a note, made it public as well, basically saying that they're trying to work with the White House to alleviate any concerns. John, what would it look like to manage up? How would Intel get out of the situation in the ire of the president that they have right now?
Yeah, I think at this point, I think the tension between the administration and Lip-Bu right now is how much they're willing to commit to manufacturing in the U.S. I think if you look at Lip-Bu's predecessor, Pat, he kind of maybe was a little bit too aggressive in terms of building out capacity to manufacture in the U.S. He was of the mindset of, if we build out this capacity, they will come. Lip-Bu, as we've seen, has taken a much more disciplined approach at spending. He's come out and he said, we are very excited about our next process node, 14A, but we are going to be much more disciplined about it, right? If 14A doesn't pan out as we'd like, I'm not ready at this point to fully commit to 14A, which is leading edge manufacturing in the U.S. So I think he's got to carefully choose his words and communicate to the White House that he's fully committed to U.S. manufacturing, but he's got to be very careful about committing the full amount there, and just be very careful about how he selects his words.
John, how can he be explicit to the President of the United States when the Wall Street Journal this morning is saying that he and some Intel directors have disagreed about simple questions as whether or not the company should stay in the manufacturing business or exit entirely? Doesn't he need to shore up his own company, the directors, the board, before he starts making matter-of-fact statements to the President of the United States?
Yes, I do agree that he's got to kind of figure out also how to manage the board, but it's not a surprise that they're having differences, but I think this is why they needed to bring him in. Pat, the previous CEO, had the full support of the board, and obviously that strategy wasn't working. So they had to bring somebody in to kind of change up the strategy, and I think that's what the board and Lip-Bu are going through right now. They're going through some of those growing pains.
John, I would love to get your read on the wider chip sector now that we've had some of the earnings under our belt. It was an AMD that was punished for voicing uncertainty when it comes to whether or not they'll be able to sell some of their key technology in China. You had the likes of NXP, for example, saying they were uncertain of how much of a pull forward they had in terms of orders. Just how much clarity do you have on the sector as a whole for where we move from here with some of these tensions still very front and center?
Yeah, there are clearly a lot of cross currents right now. I think the trend that we are seeing, last night we had market ship, which was a great print. The stock's down 8% pre-market today. I think what we're seeing right now is it doesn't matter how good your print is and how good your results and guidance is. Everything's getting sold in this market. I think people are very nervous that a lot of the strong results that we're getting in this environment is a function of pull forward demand related to tariffs. I think there's a lot of concerns that this could result in a weaker second half. There's a lot of concerns that this could undermine kind of the cyclical recovery that we're seeing in the broader chip sector. And then on top of that, right, you've got these geopolitical uncertainty that is layering on top of that, right? Just the other day, just in the middle of the earnings period, you had the Trump administration levy a 100% chip tariff on companies that aren't willing to commit to building in the U.S.
Right, and then potentially export controls. And do they actually mean that they're going to be licenses that are going to be taken back, or will they just be U-turned like we saw with the H20? John, thank you so much for your time this morning. John Vinh of Keybanc Capital Markets. Collin Collin Martin of Charles Schwab, writing, the need for a new Fed chair to cut rates could be a moot point. By the time Fed Chair Powell's term is up next year, the Fed may have cut 3 or 4 times. Collin joins us now for more. Isn't this the irony of all this? The president is really jawboning the Fed and wants to talk about maybe regime change at the Fed. By the time he gets some of these appointments, they've already done what he wants.
I think so. I don't think it's really going to matter because what we saw with obviously the headline about the weakening labor market now, there was already some support for rate cuts. It seems like there's even more support for rate cuts based on comments from various Fed officials. And the data basically says that if we do get that weakening labor market, and if we look forward to say April, May, June of next year, the markets are pricing in 3 or 4 rate cuts. So even without the headlines of a new Fed chair, who's it going to be, how dovish are they going to be, we might see a Fed funds rate 100 basis points lower than where we are right now. That doesn't mean that the jawboning might end. It doesn't mean that we might not get a new Fed chair who is as dovish as the administration wants, but we have to remember that it's a committee. And I think most committee members, whether it's a governor or a district bank president, they look at their dual mandate and I think they're more methodical about how they're going to go about it. So even the headlines might not stop, but I think cooler heads will prevail.
Some people have made the point, though, and Paul Donovan at UBS included, that Waller's actually the most dovish pick you could have for a Fed chair because he has credibility with the rest of the committee and could sway them to more dovish outlook. Is that right? Would a Waller be the most dovish pick over the Kevins, over anyone else?
Based on what we've seen, I don't know if he'd be the most dovish pick, but he's clearly dovish. We could argue he's the most dovish member of the committee right now, governors and district bank presidents. But he's not out there talking about the need for a 3 percentage point rate cut or something like that. If the data were to change, maybe his tune or tone would change. But right now, we're not seeing that. So it seems like he could be in line to be the next Fed chair. There's a lot going on. You know, we have the temporary announcement for Myron because we don't really know what Powell's going to do. So if Powell stays on and Waller's already in there, he could be a logical choice without making too many headlines or without having to worry about the confirmation process.
Well, so when Stephen Myron was announced, the market reaction was slight, but there was one there, a little bit of curve steepening. If you get someone like a Myron or, again, one of the Kevins, a less traditional sort of appointment to the Fed chair, would you put on steepeners? Does that trade make sense?
We think steepeners make sense regardless because we think short-term rates are likely coming down based on the data we're seeing. But at the same time, we have fiscal concerns that likely aren't going away anytime soon. And the idea that inflation might stay elevated. We're not expecting a reacceleration, but the idea that with the tariffs in place right now at relatively high levels, we can see it stay higher than we would have expected if we talked about this, say, 6 months ago. So we think maybe long-term rates stay where they are, maybe come down a little bit, but likely not as much as short-term rates. So I think whoever is in charge of the Fed over the next 6 to 12 months, we think the curve should continue to steepen.
I was talking to Neil Dutta yesterday, and he joined the program this morning. He was talking about the fact that Powell basically holds the cards. If it is someone that seems overtly political, that the Trump administration wants to put as the Fed chair, do you think he stays on?
I don't know. And I say that because it's anybody's guess right now. And I think he's in a really difficult position. On the one hand, he doesn't want to, or I think he does a really good job of not politicizing it because he basically doesn't say much. Anytime someone asks him a question or someone brings it up at the press conference, he just defers and says, we're looking at the data. Now, if there's a push for someone who is, very partisan, very political, and is very loud about the need to cut rates sharply, which the data right now doesn't support, maybe he stays on because his term as governor doesn't end for another few years. But I think he's in a really difficult position because that makes it seem like he's politicizing it, when at the end of the day, I think he's just trying to uphold the integrity of the committee because I really think he's trying to do the best he can.
So you think he's trying to protect the institution? But he, in the end, if he were to do that, he would end up becoming almost a shadow Fed chair. How could the market deal with that?
That's a great question. I think we just have to understand that, again, there's a lot of committee members. So whether I wouldn't say he'd be a shadow Fed chair. He would just be one other voting member. I think he has the respect of a lot of his colleagues out there.
That's like a senator saying that they're going to run for Congress, for the House.
I think if he was there...
They actually do that,
He'd be a voter. And he would vote based on what the mandate suggests and what the data suggests. We have a lot of time before next May. I think it's going to be a really exciting couple of months.
Well, we have a lot of time, but we have so much information to digest before that time. And this week we had both a 10 and a 30-year auction, and both of them were pretty weak, or at least just lackluster, let's say. Do you look at that and say, okay, this is real concerns about a ballooning deficit and Fed independence, or is it just yields have been lower since the payrolls data, there was less demand?
I'd say all of the above. When we look at the fiscal concerns, which are clearly there, and there doesn't seem to be anyone on either side that wants to fix this right now from in the grand scheme of things. And if we have this, rising deficits, rising debt, we need to find more buyers there. So I think that's one of the reasons why we think yields could stay elevated for a little bit. We're not worried that they're going to shoot significantly higher to, say, 6% levels, 7% levels, but if there are concerns and weak auctions like we got this week, weak at the margin, nothing crazy, but it shows that maybe there's a slight pullback in demand. That's another reason why yields can stay elevated when we see a steeper yield curve.
Okay, so to that point, bringing the whole conversation around, if you have an appointment to the Fed that in practice doesn't matter because it's already going dovish, but gives that appearance, especially to foreigners, to seem to be one that kind of chips away at the Fed independence, does that then matter because it makes foreigners less willing to fund the twin deficits of the U.S.?
I think it would matter, and this is something we talk about a lot, about the idea of Fed independence. We're not worried right now that they're going to lose that. I mean, there's a lot of headlines about it, but we've talked to ad nauseum this morning about it's a committee. But that would be a concern for us. If there was a lack of independence, we think we'd likely see a weaker dollar. We think we'd likely see long-term yields rise because of that loss of confidence in the markets. And when we look at what we've seen in the tick data, basically from Liberation Day, initially the first month we actually saw foreign private investors sell a lot of their treasury holdings. That then reversed in May. So we kind of have a cloudy picture right now. We're not really sure what the long-term trend will be, but what that shows us is maybe more volatility, and that in and of itself would result in kind of that higher term premium.
Collin, as we close out the week, what are you looking for next week? Is everything just going to be dominated by CPI?
I think so. I think we'll have to look under the surface. I mean, the headline gets a lot of headlines, but we'll have to see what the difference is between goods and services, and we'll have to see how much pass-through we're seeing in terms of goods, the imported goods, but are we seeing a slowdown in services? Because I think that's the big dichotomy right now.
Collin, thanks so much for your time this morning. Collin Martin of Charles Schwab.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.